Good evening, everyone. Thanks for watching. Welcome to a special edition of As the Tariff Turns. I'll be your host, Paul Schatz, Heritage Capital. So it is the evening of April 3rd on the heels of President Trump's massive tariff plan being unveiled and confirmed. Before I get into that, as I said, thank you so much for watching. I do appreciate it. If you have any questions, comments, concerns, you can pick up the phone and call me in the office. You can call my cell. You can also send me an email, whatever works best. If you like the video, please give it a thumbs up on YouTube. If you don't, that's okay as well. No harm, no foul. So let's dive in. And so we know today was a particularly rough day for all of the risk-on assets in the markets. I had a funny client text me and ask me if I have any hair left. So it hasn't fallen out and I haven't pulled it out yet, but it's definitely, I went to a funeral yesterday and a couple of people commented that my hair is graying more than it was before. And I'm looking more and more like my dad. Longtime clients probably remember my dad, who had almost a full head of hair like I did in his 80s, and it was gray on the side. In any case, I still have my hair. It's a little grayer. I do appreciate, I always find it interesting when markets fall precipitously. I always find it interesting when people reach out to me and say, "Are you okay? Are you doing okay?" Listen, I've been doing this 35 years. Nothing I say, I take nothing for granted. I am blessed. I've had a great career, and I hope I've got another maybe 20 years left doing this. But I've seen so much in 35 years doing this. It's not that I'm not cavalier and I don't take it for granted what goes on in the markets. It's just that kind of been there, done it. Each period of rough markets is kind of unique. So, 1990, Iraq invaded Kuwait. I was new, or only in business 2 years. 94, Orange County, California defaulted. October 97, there was that emerging currency collapse. In 98, Russia defaulted on her debt, long-term capital, then the dot-com bubble, then 9/11, and then WorldCom, Enron, all that fraud, and then the great financial crisis. And then we had the European debt crisis in 2011 and China in the summer of 15. I'm doing this all from memory, sorry. And then we had the Fed in 2018, COVID in 2020, 2022, the worst diversified investing year in history, inflation, and now 2025, we have something new. So I want to say a couple of things. Let's see. Number one, today, although I've said all along that most of the market decline was not tariff related, I stick by that. It was not. It was a growth scare that Walmart started on February 20th. Today, April 3rd, was the direct result of President Donald Trump's tariff plan. A lot of people emailed me today and said, was I surprised by market reaction? I'm surprised at how surprised the market was, because he kept saying what he was going to do. And it's with all the noise and nonsense in DC, it's so hard. Tariff on, tariff off, wax on, wax off. As you know, if you've been reading me, I am dead set against any and all tariffs. Nobody wins a trade war. They're just varying degrees of losers. We're going to lose. The Canadians are going to lose. The Chinese, everybody loses. So if you want to say if we lose the least, we win, fine. If that makes you feel better. I don't feel that way. I'm fiscally conservative, as most of you know, and I believe in free trade. And I think the way we should have done this, and it's the wrong president for this, I get it. That's not his style. That's okay. Elections have consequences, and the people elected this president. They elected Joe Biden before that and Trump before that, and on and on. Being the United States, whether it was under Obama or Bush or Biden or Trump, I would have gone to the WTO, the World Trade Organization, and I would have pushed for removal of all tariffs all over the world. You want to be part of the WTO? No tariffs. let the best goods and prices fall where they may. Again, I am against tariffs and protectionism. You can't protect or tariff your way to prosperity. Just like you can't tax your way to prosperity. It does not work. I understand this is more of a populist movement. I understand what's going on, but economically, you can't do this and think you're going to be in this nirvana place down the road. It doesn't work like that. I would love to be wrong. I don't think I am, but if I am, I'll say, hey, folks, I was wrong. Every day I'm wrong at something. I mean, I don't have an ego when it comes to that. I know I make mistakes every single day. I just try to learn from them. So that's my thinking on tariffs. That's how I would have handled it. I don't like the abruptness and the shock to the economy. I get why they're doing it. I just don't agree with that strategy. My view remains the Fed is 10 times more important than any policy out of any administration. When the Fed makes a mistake, like they forgot to raise rates starting in 2020 when I was pounding the table, we had inflation above 9%, and we had the single worst diversified investing year ever in history. 2022, stocks go down 20 to 30%, bonds go down 13.5%. Never before, because normally when stocks collapse, bonds rally. Didn't happen in 2022. That was a tough year. I don't like people like, well, how do you live through this? Again, 35 years doing this, I tell this to clients and prospects all the time. We follow our process. Some years are better than others. Are we always right? Absolutely not. But we follow the same unemotional or non-emotional. I forgot, I don't know which is the right way to. Anyway, we follow our process. Our process usually works. Again, not all the time, not every day, not every week, not every month, not every year. We have good years and bad years. I like to say in a 5-year cycle, I think we're going to have 3 really good years, one's El Stinko year, and 1 wild card year. Does it always happen like that? No, because 2000, 01, 02, 3 years in a row that were really bad. 01 and 02 were particularly bad. So that's, again, we follow our process, and that's how I can get up and go to work every day. We don't worry about geopolitical events. I don't believe anyone, that's not fair, I'm sure. I don't believe that the vast majority of people can manage money based on geopolitics, because if you did, you'd never invest. Every day there's some geopolitical concern. Is it Iran? Is it China? Is it Russia? Is it Afghanistan and the Taliban? So that's why we created an unemotional process and we follow it. You don't have to agree, but that's what we do. And it's served me well for 35 years. So let's do this. I'm going to show the bond market chart. I'm going to throw a tidbit out. As you know from my writings and what I published in my 2025 forecast, I said I expect a 10% plus decline in Q2 or Q3 that lasts 7 to 9 weeks. Well, and then I thought we'd have a single-digit decline in Q1. The decline we had looks like it was my 2 declines compressed into 1. Markets are probably down. The S&P is probably down about 12% from high to low in the past, 5 weeks, 6 weeks. NASDAQ's probably down 15, 16% over that time period. So this is the decline that I had written about. It's just, and it's so much more difficult to live through as an investor than to talk about it and write about it. I get that. Declines typically shake investors to the core, which is why declines change investor behavior. I'm not going to change my behavior because I do the same thing I do every day. So here's a good tidbit. And if anyone wants to fact check me on it, please be my guest. When the month of January is up, your maximum loss over the ensuing 11 months is 17%. The maximum. Doesn't mean, and we rarely get there, but in history, doesn't mean this can't be a precedent. When January is up, the biggest loss you have going forward for the rest of the year is 17%. Take that for what it's worth. I love doing those little data mining studies. I find them fun. So let's do this. Let me share my screen, get my cheat. I can see better now. Let us first go here. All right, so you can see that. So I had said all along that I don't think tariffs are the cause of most of the decline, and I think it's a growth scare. This is the chart. The red and white is the 2-year note. It's the risk-free rate of return that many people use in their models. The 2-year note it's like a 2-year bond, except it's a note, not a bond, issued by the government. It is now 3.7%. What does that mean? Well, the Fed's at 4.3%. So you've got 0.6% that the 2-year is below where the Fed is. And the 2-year has been below the Fed since early 2023. This tells you the Fed is behind the curve. The Fed should be cutting rates to catch up to the 2-year. My sense is that the 2-year is going to fall further. So for all those people who are so freaked out that tariffs are going to lead to this inflationary spiral, you're wrong, because if we were going to have an inflationary spiral, you'd see it in the bond market first, like on this chart right here. Instead of being at 3.7, be at 4.7. The bigger issue is that the economy, which I mentioned last year, had many cracks last year. It caused me to look for growth to slow this entire year. And I said inflation was dead. I still think inflation is dead. Could there be a month or two spike? Sure, but we're in a downward trajectory, and we are going towards 2% for the wrong reason. We're not doing it, kind of organically and naturally. Well, we are naturally, but we're doing it because the economy is slowing, and maybe slowing a little bit more than I had thought. So the Fed, I said it 2 weeks ago, the Fed should have cut rates 2 weeks ago, 0.25%. They didn't. They're worried about inflation, which is dead. They look like they may cut at a higher percentage in May. They should cut 0.5% in May. My guess is they'll do 0.25% in May and 0.25% in June. So that's what the Fed's behind the curve. They could certainly help the economy out. The economy is slowing. You can look at things like, Walmart, Nike. Who else did I miss? Walmart, Nike, and Federal Express. That tells you the consumer is tapped. You can look at uncertainty around the globe, although that's not really my ball of wax. You can look at jobless claims are increasing at a slow pace. Employment market's a little softer. There are cracks. Inflation's lower. The industrial sector is slowing. So the economy is slowing. I'd said it's going to slow between to 0 to 1% growth. I'm still on that train until proven otherwise. So that's the 2-year, and I want to share one other thing. Let's go to the 10-year note, which is also a treasury note issued by the full faith and credit of the U.S. government. What do we have? The 10-year note peaked this year at about 4.8%. right out of the gate, and it's now 4.05%. If inflation was a long-term concern, you would have the 10-year note going up, 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 like it did previously when we had inflation. It was going up, 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 and now it is going down, 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 down. If inflation was a market concern, you would have the 10-year note rallying. The 10-year note is falling because the economic slowing is way more important than any month or two pop in inflation. Okay. And I expected the 10-year note to get well under 4%, although I thought it'd be later this year. My timing is a little off. It's happening earlier than I thought. It's okay. So those are interest rates. They have come down. They're going to continue to come down. And something else I want to mention about the 10-year note, rates, inflation. No. All right. And I'm going to pivot now to my 3 scenarios, which I've written about and done videos on. This is the S&P 500. Scenario number 1, after this, during this decline, was that we were going to bottom, rally, or bounce, come down again, and then run. And I thought the final low would be sometime in middle, end of April. So this, this confused me a little bit because we bottomed, which I knew this was not the bottom. We had the nice bounce. That was good. I wrote about here that the bears should step up again. I did not think the bears were going to immediately collapse the market to new lows like they did. But that gave us an opportunity that this little, I don't know, we'll call this maybe a muted W. The climb was over and we could rally again. Well, this was a little too compressed. I wanted to see the two lows farther apart. That's why I targeted middle end of April. And then today we have the tariff tantrum and we're at new lows. So my first scenario is still alive, but it has to set up again. My second scenario was that stocks would rally from this low and kind of go straight up to 6,000 over the summer and then roll over to 5,000 after that. That didn't happen. That's off the table. And the last scenario, which was the least likely, was that stocks weren't going to bounce and they were just going to fall straight down. I guess you could say could be this last scenario. I still don't think so. I think after today's decline, we probably have another day or two of weakness before we have a more significant bounce. But we'll take, tomorrow's the unemployment number. So that's obviously a wild card in there. So those are my scenarios. I would think that if there's any kind of strongly bullish scenario, then markets are going to quickly go back to 5,600 on the S&P. Quickly, like within a week or so. That's not really likely. It's possible. That's the most bullish scenario, is that we go down for another day or two, and then we rally strongly in the next week back to 5,600. That'd be a really bullish thing. Would trap a lot of the bears. Again, not the most likely. More than likely is that we go down for a day or two more, and then we kind of sawtooth around. And what does sawtooth mean? Sawtooth means something like this. We go down for 2 more days, and we do something like this. That's sawtoothing. So that is certainly a plausible and likely scenario we shall see in the coming days. I covered. I know when I turn this off, I'm gonna remember there's something else I wanted to cover. But let's stop sharing it. Let's get rid of my cheaters. So that's what I'm thinking now. Bonds are stretched. Could they rally some more and rates go down? Yes. Could stocks go down some more? They probably will over the next couple of days. I don't think today was the low, although we have a huge economic report tomorrow, Friday morning, so we will see. I'm just trying to look around on my desk. I knew there's something else I wanted to mention. Now it's going to bother me when I click off. But in any case, I'll put it in the blog. I thank you so much for watching. Feel free to email paul@investfortomorrow.com with questions, comments, concerns. Call the office. Send up smoke signals. Again, thank you so much for watching. If you like the video, please give it a thumbs up on YouTube. And I will be back again with, if the market stays volatile, I'm pretty good at throwing a video out or doing a more lengthy blog post. So always feel free to send your questions and comments. I do appreciate them. Thanks and have a great night.